Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we are going to be looking at Hershey's stock, which came in by request. If you have a request for a stock you would like me to analyze on the channel and it's in the S&P 500, just drop it in the request in the comment section and I'll get it on my list and I will eventually make a video of it. If it's not in the S&P 500, I post those over on Patreon, and for $5 a month, you can get access to all those analyses, and you also get a big discount if you decide to join my full Cyclical Investors Club service over on Seeking Alpha. And there you can get access to the spreadsheets you'll see me use that have like hundreds of stocks on them that I monitor, as well as all my other strategies than the ones that I talk about on the YouTube channel. And you can chat with me directly and do all kinds of other things there. So those links will be down in the description if you want to check those out. As for Hershey, and with all the other analyses I share on YouTube, this isn't personal investing advice. This is just how I analyze these stocks myself. And if I haven't done any buy suggestions for a long time, but if the market keeps dropping the way that it has been, when I put a buy video out, I will actually be buying those stocks myself. I don't do buy suggestions or buy ratings unless it's something that I'm buying myself. So with that said, let's get into the Hershey's analysis. I'd like to start by reviewing any past coverage I've had of a stock. I've only written on Hershey one time before that showed up in my search. Back in 2019, September 11th, 2019, it was a sell rating. At that time, my valuation process said that Hershey would probably have a 10-year CAGR of about 1.56%. Now that was written before we had all the inflation that we've had now. So it was in 2019 before the pandemic. So if you consider about 20% inflation since then, and that it's about over 4 years have gone by, that would have just roughly estimated 6.24% growth, maybe a little bit more than that since we're a little past 4 years now. And then 20% growth from inflation. So that's about 26 or 27%, which would have been kind of the estimated inflation adjusted estimate. That comes right in between their price change and their total return, including dividends. So we're pretty close right now to where I would have kind of estimated it to be if I would have known the type of inflation that we were going to get. And they are a high quality business. They can pass inflation on, generally speaking, if it's not too crazy high over time to their customers. So I would consider buying this stock if it was at the right price. Really, the only thing that I'm looking at here is what is the price I would be willing to pay for the stock where I thought I could get better than average returns. So that's what I'll be looking at here today. So I think my method, which I've changed a little bit since 2019 to take into account higher interest rates, especially higher interest rates, I would say, and also the fact that recession risk is pretty high right now. So I would take that into account too. So those will be some differences between what I was doing 4 years ago and what I'm doing now. But generally speaking, this process is pretty similar. So the first thing I would do is check the historical cyclicality of Hershey's earnings. And generally speaking, when you just glance at the graph here, they are pretty darn steady. So it's not very cyclical, but we do see during the last recession, we did have some earnings cyclicality. So earnings peaked in 2006, which is kind of when the economy peaked, if you think of like the housing market and everything. And it just took a couple years for that to play out with earnings. So this is would be, you have a negative 12 year and minus 10 year, we'll call it minus 20 to 25% earnings growth decline. That what I would call like moderately cyclical, not, maybe just Yeah, I mean, that's pretty much how to describe it. You're going to have a couple years of weak earnings growth, and then the earnings growth comes back. And after 3 or 4 years, you have a full recovery where earnings surpass the previous peak, right? After about 4 years. So as long as you account for potential down years that can happen like this during recessions, then Hershey is a very steady earning business. I think we all know they've been around forever, and they've done well. Now, so once it's determined earnings cyclicality isn't super, doesn't fluctuate a lot, then you can look at earnings, and as long as you account for these things, earnings are fine to use for your valuation. If earnings do fluctuate a lot, then you need to use like a different type of analysis if you want it to be predictive of future stock price movements. Next thing to do is to choose the time frame. I'm going to choose a time frame from 2015 until now. You could go back all the way to 2006 probably. That's what I would have been using in 2019 when I did it. Chances are they're going to probably come out the same, except for there aren't going to be any down years here. And in order to make up for that, I have like a recession metric that I use that kind of will help us mitigate some of the dangers that we don't really have, like any like I don't count this as like a real recession. So we don't really have any real recessions in this time period. And I'll make up for that a little bit by using another technique that I'll show you later. So to get the basic valuation, what I want to know is what the PE or earnings yield is. The earnings yield is the inverse of the PE. So the PE right now is about 21. And what the inverse of that is the earnings yield, which is earnings over price. And I'll use that, and then I'll use the historical earnings growth rate that they've experienced during this time. And I'll use those two things to calculate how much earnings, if I owned this business, I could collect over the next 10 years. And then that will give me a CAGR, and I'll use that to determine the valuation, basically. So there's no down years to look at here. I would also take into account their buybacks. I didn't set that up for us. I don't think they bought back a ton of stocks, but I would adjust for it. We can probably tell by looking at the difference between Fastgraph's earnings growth, which would measure from here to the current price, and whatever I end up with, which let's just look, it's almost exactly the same. So they probably bought back just a tiny bit of stock. So mine's slightly lower. This isn't really going to make much difference. We're looking at like 9% growth, basically, earnings growth. So we have the earnings growth rate. We have the current PE ratio, which is about 20, right? And that translates to, they have just a little bit of debt. This is the difference between their real price and their debt adjusted price. Which how I do that is, if you go on Fastgraphs, if you look at their total enterprise value and the market cap, I take the difference between that and create just a percentage. So this is probably, well, I'll tell you because I did it already. This is about 8% higher. The total enterprise value is about 8% higher than the market cap. And so I basically multiply this times 8%, and then that increases the price. So I'll be a little bit more conservative. I'll treat it like it's actually trading at 204 than trading at 189 if I was going to buy it. And so I adjust for that little bit of debt, and that will come through in the PE ratio and the earnings yield that I have right here. So if this was like 20 or a little less than 20, this should actually be a little more than 5%, but I really have it at 4.67%. So it's just a little bit more conservative. And the way I like to think about that is if I bought this company and its debt for $100, it would pay me about $4.67 per year, and that would grow at like that $4.67 would grow at about 9% a year. I want to know how much money on top of my $100 that I invested would I have at the end of 10 years. I pull the first year of growth forward. So year one is not 467, it's 510. And then compound that. I do not compound the $105, only the $4, okay? And I try to see what I would end up with at the end of 10 years, which is $178. I'd put that into a CAGR calculator. So you start with 100, you end with 178. After 10 years, what does that come out to? And then my spreadsheet is set up to calculate that for me. And it's 5.94%. So the scale I use, this is like would be like the owner's earnings CAGR basically. And the scale I use is if this is under 5%, it would be a sell, right? So it's not a sell anymore. It probably would have been a sell, just glancing at it, when the price was up here at 30. But the price has come down enough where it's not a sell anymore. Let's just glance at where it was back in, so in September of 2019, it was 27. So it was a sell then, right? Probably would have been a sell if the PE was even higher than that. I'm guessing all through this range, I would have had it rated to sell, but now that the stock price has fallen, it's more of a neutral. It's not really a hold because I didn't really buy it. I like to call it neutral. So if I own the stock and I was trying to evaluate it now, I'd just keep holding it, basically. So yeah, the threshold for that is about 5% and below. The threshold to buy for me is 8% and above, and then the midpoint of that is about 6.5%. So it still looks a little expensive to me here, but not expensive enough to run out and sell it if I owned it. Now to buy it, I would want it based on just these earnings metrics and the current earnings expectations. I would be looking at 127.40 before I would buy, which is about 32% lower. Now, using the recession metric is a little interesting with Hershey because it's kind of a staple company that people tend to kind of hold on to, or maybe even buy. If you're a portfolio manager and you have to own stocks in a recession, you're going to buy some of these more stable companies sometimes. And so we might not be able to get this super cheap price, although these are pretty close together, honestly. This 135 price would be like the recession price based on the past. This is based on 2008. So the way that I do that is, and so the recession is actually, for a staple like this that people might want to buy during a recession, is the buy price is actually a little higher than I might want to actually buy it at. But they're pretty close together. So what I do is I go back and I look at the low price and I compare that to the high EPS before the decline started. So these actually happen in different years. So you take the low price, divide it by the high earnings, the peak earnings, and that will give you a recession PE of, I'll tell you, I forgot it. I just looked at it, of 1277, okay? And then what I do basically is I say, okay, how close do I want to get to that recession PE before I would be willing to step in and buy, rather than trying to pick like the exact bottom. And that would be about 20%. I decided to go with 20% higher than that, which is a PE of 15, which generally speaking is just like an average, like through the history of the stock market, like a 15 is like a fair PE basically to pay, probably for a stock that's growing about 9%. So that would be kind of like if you think of like growth at a reasonable price, I mean, that's kind of a growth at a reasonable price amount to pay. And that's where I derive this number here. It would be within 20% of that recession PE. And these are both kind of pointing to the same level. About 30% lower than where it trades today would be where I'd step in and buy. That would have like a margin of safety. And it's also, because of this recession PE is based on 2008, it's a spot that if we had a recession, it could reasonably actually get there. They aren't like crazy low. prices. Now, people would have told me they were crazy low last year, right? Maybe even in 2019 when I first thought it was worth selling, because the stock price definitely went higher. But to have a margin of safety, you can't be buying when it's a 25 PE grown at 9%. You really would need interest rates to stay low forever. These are type of the things that people were pricing in then. Or you'd be buying it for dividend safety. There's a lot of things that suck people into these stocks at too expensive of a price, in my opinion. So, but it only has a 2.4% dividend yield. Even on it, I might track this on my dividend. I'm not going to pull it up right now because my spreadsheet's not out, but it would not be anywhere close to a buy based on dividends. So I'm not sure how long it would take to actually for you to get paid back on dividends, but I can just say, just glancing at it, it's not a good dividend stock based just on the dividend and dividend growth, because it's not even a good buy yet based on the earnings and the earnings growth. And that earnings growth rate is, the earnings yield is actually closer to 5%, and the dividend's only half that. So they aren't paying you back enough in dividends to buy it just based on dividend and dividend growth. But it could be a good buy, or I should say the buy price for that is going to be lower than the one that I'm looking at now. It's going to be lower than this 130 level. I can just say that just from looking at it. So that's kind of my take on Hershey's. It's a hold right now, but you're probably looking at a lower. If we have a recession, the price is probably going to go lower. But if it's a mild recession, who knows? It's not so overvalued now that I would say this is a clear sell. You can find easier things to buy. I can't really say that anymore. It's probably trading about the same as the S&P 500 right now, based on everything that I can kind of estimate. So a hold right now, and if it falls about 30%, now it's looking like a pretty decent long-term opportunity. Probably not going to be a killer in terms of like returns, but you do have kind of that stability that you would be paying up for a little bit. So if you're a retiree or you're getting close and you want to take out some of the volatility in your portfolio, then buying this when it's about around that 130-ish level is probably a decent bet. Especially if we have stagflation or inflation, and it would become more attractive relative to bonds at that point, and a pretty decent buy and hold opportunity going into like retirement. Okay, if you have any requests you would like me to take a look at, put them in the comment section and I will get them on my list to make videos. And make sure to subscribe if you want to see more analysis. I'm putting a lot of these out, pretty much one a day. I mean, I don't have a schedule, but my goal is to kind of put one out about every day, and that's going to be 300 in a year probably. So we got a lot more coming. Thanks for watching, and I'll see you later.